It's May 12th, 2026, and there's a gas station in Nevada that used to pump 80,000 gallons a day. Now it pumps nothing. A sign still flickers, showing a price that nobody believes, and the pumps stand like monuments to a system that just stopped breathing. We're told this is about supply chain issues, about geopolitics, about temporary shortages. But that's the story they want you to believe. The truth is simpler and far more terrifying. This isn't a fuel crisis. It's a debt crisis disguised as an energy problem. And the ledger doesn't care about your excuses. Let me take you back to understand how we got here. For decades, America ran on a promise. Not just a promise of prosperity or freedom, but a financial promise written in treasury bonds and backed by petroleum. The entire global energy infrastructure was built on borrowed money, and that money was always borrowed against future oil revenues. Think about that for a second. Every refinery, every tanker, every pipeline was financed with debt that assumed oil would always flow and prices would always rise. It was a Ponzi scheme written in crude. The system looked magnificent from the outside. By 2024, global oil production hit 102 million barrels per day. The United States alone was producing 13 million barrels daily, a number that would have seemed impossible just 20 years earlier. Refineries stretched across the Gulf Coast like industrial cathedrals, processing millions of gallons every hour. Tankers the size of small cities moved across oceans, carrying liquid wealth from one continent to another. The trucks rolled 24 hours a day, the pumps never stopped, and the world kept accelerating. But beneath every barrel was a balance sheet drowning in red ink. The major oil companies collectively carried over $900 billion in debt by early 2025. That's not a typo. Nearly $1 trillion owed to banks, bondholders, and foreign creditors. The independent refiners were worse, leveraged at ratios that would make a casino blush. Some were operating at 12 to 1 debt to equity. One bad quarter, and they'd be insolvent. One shift in interest rates, and the whole tower would collapse. And then the interest rates shifted. The Federal Reserve, desperate to control inflation that had been building since 2021, pushed rates to 7.5% by March 2025. For consumers, that meant expensive mortgages. For oil companies, that meant financial death. Suddenly, the debt that cost them 2% to service now cost them 4 times that amount. Refineries that were barely profitable at low interest rates became money furnaces at high ones. Every month, billions in interest payments bled out of the energy sector and into the hands of creditors who didn't care about keeping the lights on. The first crack appeared on August 3rd, 2025. A mid-sized refinery in Louisiana, processing 200,000 barrels a day, filed for Chapter 11 bankruptcy. The company owed $4.2 billion and couldn't make its quarterly interest payment of $68 million. The news barely made headlines. Analysts called it an isolated incident, a poorly managed company that took on too much risk. But the insiders knew better. That refinery wasn't unique. It was typical. And if it could go under, so could a dozen others just like it. By October, 3 more refineries had declared bankruptcy. Combined, they represented 600,000 barrels a day of refining capacity, just gone. Not destroyed, not damaged, just financially erased. The facilities still stood, but the banks had seized them, and banks don't know how to run refineries. They know how to liquidate assets. So the equipment got auctioned off, the workers got laid off, and the fuel that should have been produced simply vanished from the supply chain. Gas prices jumped 40 cents in 2 weeks. Then came the sovereign debt trap, the real monster in this story. You see, most people don't know that oil-rich nations use their reserves as collateral for massive infrastructure loans. Venezuela owed $150 billion backed by oil. Russia had borrowed $80 billion against future exports. Even Saudi Arabia, the king of petroleum, had leveraged its reserves to fund Vision 2030, a modernization plan that cost over $500 billion. These weren't investments. They were bets. Bets that oil would stay above $80 a barrel forever. It didn't. By December 2025, crude oil crashed to $52 a barrel. The reasons were complex, a perfect storm of recession fears, overproduction, and a sudden glut as China's economy stumbled. But the effect was simple. Every petrostate that had borrowed against $80 oil was now insolvent at $52. The math was brutal. Saudi Arabia needed $78 a barrel just to balance its national budget. At $52, they were bleeding $15 billion a month. Russia needed $65. They were losing $8 billion monthly. These nations couldn't default in the traditional sense, but they could stop exporting. And they did. On January 14, 2026, OPEC announced an emergency production cut of 4 million barrels per day. They called it market stabilization. It was actually economic triage. These countries couldn't afford to pump oil at a loss, so they just stopped pumping. The global supply dropped overnight. Prices spiked to $110 within 72 hours. And that's when the real crisis began, because high prices didn't solve the debt problem. They made it worse. Here's the trap that nobody saw coming. When oil hit $110, the refineries that were still operating couldn't afford to buy crude. Their debt service was already crushing them, and now their raw material costs had doubled. They couldn't pass the full cost to consumers because demand was collapsing. People were already driving less, buying less, living smaller, so the refineries just stopped buying. They ran down their inventory, and then they shut down. Not bankrupt yet, just idle, waiting for prices to stabilize, for the debt to magically disappear, for a miracle that wasn't coming. By March 2026, 35% of U.S. refining capacity was offline, not because of explosions or hurricanes or technical failures, because of insolvency. The fuel existed underground. The refineries existed above ground. But the financial mechanism that connected them had failed. It was like watching a heart attack in slow motion. The blood was there, the organs were there, but the circulation had stopped. The government tried to intervene, of course. On March 28th, the Department of Energy announced a $50 billion emergency loan program for struggling refineries. The terms were simple. Stay open, keep refining, and we'll cover your debt payments for 6 months. It sounded like salvation. It was actually a band-aid on a bullet wound. Because $50 billion divided among dozens of refineries barely covered 2 months of operations. And it did nothing to address the underlying problem, that these companies owed nearly $1 trillion they could never repay. The smart money knew it was over. By April, the hedge funds and private equity firms that owned stakes in energy companies started dumping their positions. They sold at 30 cents on the dollar, taking massive losses just to get out before the collapse. The bondholders panicked next. Bonds that were rated investment grade in January were trading as junk by April. Some energy bonds were selling for 12 cents on the dollar. That's not a discount. That's a eulogy. The market was pricing in total default. And then came the smoking gun, the document that sealed the fate of the entire system. On May 1st, 2026, the Federal Reserve released an internal memo that had been leaked to the press. It was titled Systemic Risk Assessment, Energy Sector Insolvency. The memo was clinical, almost cold in its precision. It stated that 60% of the domestic oil and gas industry was technically insolvent. It estimated total losses at $1.2 trillion, and it concluded with a sentence that should be carved in stone. There is no mechanism for bailout at this scale without triggering sovereign debt crisis. Let that sink in. The Central Bank of the United States had just admitted that the energy sector was too big to save. Not too big to fail, too big to save. Rescuing it would require printing so much money that the dollar itself would collapse. The choice was stark. Let the energy companies die, or let the currency die. They chose the companies. They chose you. The memo leaked on a Thursday. By Friday, 7 major refineries had announced immediate closure. Not bankruptcy filings, not restructuring, just closure. The machines stopped. The workers went home. The fuel stopped flowing. Gas stations across the Southwest started running dry by the weekend. By Monday, the lines began. By Wednesday, the lines stretched for miles. And by the following Monday, May 12th, stations started going dark. No fuel to sell, no trucks coming, no hope offered. The government issued statements about strategic petroleum reserves and emergency protocols. They released 30 million barrels from the reserve, enough to supply the country for about a day and a half. It was a gesture, a performance of control in a situation where control no longer existed. The real power now belonged to the bondholders, the foreign creditors, the banks that held the debt. And they wanted their money, not excuses. Think about the scale of what happened next. Within 2 weeks, 40% of American gas stations had closed. Not because they wanted to, because they had nothing to sell. The trucks that delivered fuel were running out of fuel themselves. The paradox was almost darkly comic. Tankers sat in depots, full of gasoline, unable to deliver it because the trucks had no diesel. The system was eating itself. The social unraveling was swift and predictable. Grocery stores ran out of fresh food first, then canned goods, then everything. The trucks weren't coming. Hospitals started canceling non-emergency procedures because ambulances couldn't guarantee they'd have fuel. Police departments rationed patrols to essential calls only. In rural areas, towns became islands, cut off not by disaster, but by simple economic physics. No fuel means no movement. No movement means no society. The elderly died first, those dependent on oxygen concentrators and generators. When the power grid started browning out from lack of fuel deliveries to backup plants, the machines just stopped. Then came the diabetics who couldn't get insulin shipments. Then the people on dialysis. These weren't dramatic deaths. There were no explosions or violence, just quiet, bureaucratic death by spreadsheet. The ledger decided who lived, and the ledger didn't care about your medical needs. By June, the federal government had effectively lost control of the situation. They couldn't force refineries to operate at a loss. They couldn't print enough money to pay off the debt without destroying the currency. They couldn't import enough fuel because other countries were facing their own crises. The only tool they had left was rationing, and even that required fuel to enforce. It's hard to implement martial law when your military vehicles can't leave the base. The breaking point came on June 19, 2026, when the Treasury Department missed a payment on its own bonds. Not a default, technically, just a delayed payment blamed on technical issues. But the world isn't stupid. A missed payment is a missed payment. Within hours, the dollar dropped 8% against a basket of currencies. By the end of the week, it had lost 20%. Foreign holders of U.S. debt started selling, not because they wanted to, but because they had to cover their own obligations. The spiral was global now. China, holding over $800 billion in U.S. Treasury bonds, demanded payment in physical goods instead of currency. They wanted grain, machinery, anything tangible. The European Union froze dollar transactions pending stabilization. The financial architecture that had held the world together since 1944 was coming apart in real time. And it all traced back to one simple fact. The energy sector had borrowed money it couldn't repay, and energy was the only thing backing the currency that borrowed money was denominated in. The irony was suffocating. America had more oil in the ground than almost any nation on Earth. The technology to extract it existed. The infrastructure to refine it existed. But the financial system that connected those things had failed. It was like dying of thirst next to a river you couldn't afford to drink from. Sovereignty is solvency, and the nation was broke. By July, the official unemployment rate hit 22%, though the real number was certainly higher. Entire industries had simply ceased to function. Airlines grounded their fleets. Shipping companies declared force majeure on contracts. Manufacturing plants shut down for lack of raw materials and workers who couldn't commute. The economy wasn't shrinking. It was disintegrating. The human cost is still being calculated. We know that approximately 40,000 people died in the first 3 months of the crisis from causes directly related to fuel shortage. Lack of medical care, inability to heat homes, malnutrition from food scarcity. Those are the documented deaths. The indirect toll, suicides, overdoses, violence born from desperation, will take years to fully understand. Every number represents a name, a family, a life that ended because a balance sheet didn't balance. And the debt? It's still there. The oil companies that declared bankruptcy didn't make their obligations disappear. They transferred them to pension funds that held their bonds, to banks that lent them money, to taxpayers who will eventually be asked to cover the losses. The current estimate is that cleaning up the energy sector insolvency will cost $900 billion over the next decade. That's $7,000 for every household in America, paid through some combination of taxes, inflation, and reduced services. Some of the debt will never be repaid. It will be written off, restructured, or inflated away, but someone always pays. That's the iron law of finance. You can move the cost around, hide it in accounting tricks, spread it across generations, but you cannot make it disappear. The fuel crisis of 2026 will be paid for by children who haven't been born yet, through lower living standards and diminished opportunities they'll never know they lost. There's a lesson buried in this catastrophe, one that applies to every empire that ever fell. You cannot borrow your way to prosperity indefinitely. You cannot build a civilization on debt and hope the bill never comes due. And you cannot assume that the systems that delivered abundance yesterday will still function tomorrow. The Roman Empire didn't fall to barbarians. It fell to inflation and debasement of currency. The Soviet Union didn't lose the Cold War to NATO. It lost to an economy that couldn't produce soap and bread. And the American fuel crisis didn't happen because the oil ran out. It happened because the money ran out first. We're living through the aftermath now, in late 2026, trying to rebuild a system that understands its own limits. Some refineries are reopening under new ownership and more realistic financing. Some debt has been restructured. Some lessons have been learned, but the ghost of May 2026 haunts every decision. The lines at the gas station, the dark pumps, the quiet realization that movement itself had become a luxury. The world didn't end in fire like the doomsday preppers predicted. It didn't end in nuclear war or climate apocalypse. It ended in a spreadsheet, in an accounting error multiplied across an entire economy, in the slow death of systems too complex to save and too important to lose. The collapse nobody saw coming was visible in every quarterly report for years. We just chose not to look, because looking would have meant accepting an uncomfortable truth, that our way of life was built on a foundation of debt, that our mobility was financed by obligations we could never fulfill, that the freedom to drive anywhere, anytime was always temporary, always borrowed, always one interest rate hike away from ending. So the next time you pull up to a pump and the fuel flows freely, remember May 2026. Remember that the line between civilization and chaos is thinner than you think. Remember that it's not measured in weapons or walls, but in balance sheets and interest payments. Remember that history isn't decided by generals or politicians. It's decided by accountants with calculators, deciding who gets paid and who gets liquidated. The ledger always wins, and the ledger doesn't forget. If you want to be ahead of the curve, if you want to understand the economic forces that shape history before they shape your future, subscribe to this channel, because the next crisis is already being written in some balance sheet somewhere. And most people won't see it coming until the pumps run dry again. Don't be most people. Know the history they don't teach. Understand the numbers they don't explain. Because in the end, the only thing more expensive than learning from history is refusing to. The fuel crisis wasn't about fuel. It was about debt. And the debt crisis isn't over. It's just getting started.